Good morning. It's a pleasure to be here. Thank you, Olivia and Anna Maria, for putting together this very interesting program and having me here to give a bit a broader perspective on household debt. I work for the IMF, and we did a study together with my colleagues, Adrian Alter and Alan Fang, where we looked at household debt across the world and its implications for financial stability and the macroeconomy. This talk builds a little bit on the talk we heard over dinner yesterday by Atif Mian, and actually he informed our work. This paper comes from work we did in 2017 for the Global Financial Stability Report, and the ensuing work is a working paper. So without further ado, let me go to the presentation. And why are we interested in household debt? Because a large part of our members, central banks and authorities of the IMF have signaled the increase in household debt as a major risk in their financial stability reports. And it's clear to see when we look at the distribution across both advanced and emerging market economies that we see why that's the case. If you look here, this is the average in blue household debt to GDP ratios in advanced economies. You see over time they have increased substantially from about 25% to over 60% of GDP between 1980 and 2017. But there's a huge variation. Some countries have more than 100% household debt to GDP. And especially those countries send out warning signals. But the same is true in emerging markets. They start from a very low level of household debt to GDP, but has been increasing, and even more rapidly if you look at the pace in those countries. But there again, you see a substantial variation across countries. So what we do in this paper, we have some questions. First one is to look at what's the relation between household debt and macroeconomic outcomes over the business cycle, which follows the methodology that Atif Mian yesterday laid out. But we do it for a much larger sample of countries. In his case, he looked mainly at OECD countries. We bring in more countries and the emerging markets also, where a priori we would expect maybe a different relation because they are subject to different conditions, building for growth and development, financial development and so on, that would give them some slack. We'll see what that is. Secondly, we also study more the conditions under which we observe this relation between household debt and macro financial outcomes. What difference does it make when we look at different countries in terms of their institutional setup and behavioral patterns? Does that make a difference? When we look at micro factors, the income distribution differences, inequality measures, does that play a role? And this is a macro paper mostly, but we also look at micro underpinnings and micro level evidence to some degree, and we try to reconcile the two. And finally, is actually, we are in a policy environment. We look also at what are the implications for policy, what can policymakers do with this. Now, main takeaways, let me give this straight up. First, we find that this negative association of household debt and future GDP holds in the medium term. In the short term, you have a positive effect, so there's a bit of a trade-off, basically, that it can give you a boost in the short term, but you'll be hit in the medium term. That's true both in advanced and emerging markets. Second, we see that policies matter, and there's large differentiation across countries. If you adopt very good policies, your country and your household debt will have less of that negative connotation in the medium term. There's also an impact of distributional measures. We know that most debt is owned by higher incomes households. We saw that yesterday from the micro perspective. But we find also that the most vulnerable are the low-income households, because they have higher debt-to-income ratios and lower or higher loan-to-value, so they are more at risk. We also find there's a relation with financial stability. Household debt serves as a reliable early warning indicator of problems down the road in the banking sector. And also for stock markets, it has an implication of neglecting downside risks. And with policy, we find that, although it's not part of this paper, but more part of the report that we put out, the GFSR, that macroprudential policies can play a useful role. So if anything you need to remember from our presentation, it's those three key charts here. The first chart illustrates this trade-off between short-term positive effects of increase in household debt at time t and the negative effects 3 years later, both in advanced and emerging markets. In the middle, we see that policies matter. Here we look at different evaluations of this relation for countries that score at the 25th percentile, the median, and the 75th percentile in terms of where they are in terms of the quality of their institutional setup. That includes the capital account openness, the quality of supervision, transparency, the availability of a credit bureau, income inequality, and you see that actually if you have a score at the highest range, this relation can actually turn positive. In terms of macroprudential policies, we do find that it's possible to contain credit growth, which is an impetus for the increase in household debt, both in advanced and emerging market economies. So without further ado, I'll go into more details now of our analysis. I want to say that we first focus on the business cycle frequency, short-term, medium-term. There is also another part where you could look at the long-term financial development type analysis. And there's a literature out there that says that, okay, if, an increase in private sector debt is good because it allows for more financial development and that would allow easier access to finance, efficiency, and growth, financing your economy. But actually, recently there's been also literature saying that there may be a tipping point or too much finance, and we have in our background analysis something to also illustrate that. But we focus at the business cycle frequency, and we have several mechanisms that can play a role there. One is the negative externalities that are associated with household debt. Is if everybody borrows, the whole economy becomes over-leveraged and then exposed to an impact of a negative shock, which may be more difficult to bear when household debt is high. Okay. Some of our results. First, basic results. We find that there is a negative association between household debt and future growth very consistently. I showed you before that there is a positive effect also in the short term. It's not in here, but that comes from a different type of analysis where we allow for factor autoregressions and so on. We use several control factors, so it's not just because we have some omitted variables. This is for 80 countries. We differentiate also between advanced and emerging market economies, where we see that is the case in both country groups, and it's actually a bit stronger in advanced than in emerging market economies in terms of significance, but in terms of magnitude, it plays a very significant effect also in EMs. We have various ways to control for the techniques. We tried vector autoregressions, quantile regressions. We find the same type of relation not only with GDP growth but also with unemployment. And when we substitute for consumption on the left-hand side, and the same pattern emerges. Secondly, looking at the policy factors, institutional environment, here are some of our results where we see that a fixed exchange rate regime and high capital account openness may actually worsen the impact of increases in household debt. And why is that? You might think, okay, greater capital account openness is good because it allows you more access to finance from abroad, but at the same time it increases the risk associated with foreign currency debt and exposes your economy to a sudden stop when the capital flows stop coming in or want to escape. And we think that is the mechanism that operates through the capital account openness. With fixed exchange rate regime, you limit the flexibility how to respond as a central bank to to changes in the environment. There's some mitigating factors when you have higher financial development, larger transparency, and have lower financial risk. As a country, you're more able to pay your debt, which mitigates those effects. Also, a role is played by characteristics of households. Here we distribute our sample into two groups of countries using micro-survey data from Luxembourg Institute, which aggregates household surveys for a large set of countries. And we look at the role of two factors in particular. One is the participation of households in the debt market, and we focus on the participation of low-income groups. And when that participation is higher, we find that there is a mitigating effect. So more access to finance is actually good because there's a broader participation of the population in the economy. But at the same time, when you look at the income distribution, at the debt-to-income ratios of those lower, more at-risk households, we find that when there is a high debt-to-income ratio in those lower income quantiles, you find that it increases the riskiness for GDP growth. There's a role of behavioral factors also to do with the effect that household debt increases have on the stock market, generating a mispricing. What we see on this figure here is the increases in household debt lead to negative excess returns on banking stocks. So that's a predictable pattern that we find in the data and points to a neglected downside risk. And that translates into a higher probability in this table of a bank equity crashes controlling for other factors. We find it's robust over 3 and 5 year horizons. Looking at our micro-level data, we also find the same role as in our macro data, that higher debt-to-income ratios reduce consumption. This is a sample that draws on European household survey data. It's very detailed. The same role is played by LTV. Higher LTV reduces consumption. That's the best proxy we have for changes in income. And controlling for a number of household characteristics. Okay, I'm getting a message that I'm out of time, so I'll run quickly through my last 2 points. We find that there is a relation between household debt and banking crisis. It's very significant, increases the probability of a crisis with 1%, which is high, given that the overall probability of a banking crisis is around 3% in our sample. And as far as policy, macro-prudential policies seem to be a potent tool to contain the risks from household debt. If we find that household debt has risen too much, this is a powerful policy in one way or another to contain household debt growth. Thank you.